Hello, my dear students, and welcome back. Exams are so close, I know. And this chapter, government budget, it feels a bit heavy, right? But don't you worry at all. By the end of this quick session, you are going to feel super confident. Let's make it simple and fun.
I can see you all mugging up, studying so hard. And that little bit of exam tension, it's totally normal, Bacha. Just take a deep breath. We are going to crack this chapter, I'm telling you, together. And you'll see just how simple it is. Ready? Okay, let's go.
You know, the secret to understanding this whole chapter is just one simple idea. Ready for it? Just think of the government as one big, huge family. Our family. And the budget? It's nothing but their yearly diary, their hisab kitab, a full record of every single rupee that comes in and every rupee that goes out. Simple, isn't it? Okay, so what is this budget really? It's just a plan. The official name is Annual Financial Statement, which sounds complicated, but it's just the government's estimate of all its earnings and all its spending for one whole financial year. And you know when that is, right? In India, it's from April 1st to March 31st. It's literally our country's financial diary for the year. Now, this diary is split into two main sections. Think of it like two columns. First, you have the revenue budget. This is for all the daily, routine stuff, the regular income and expenses. And then there's the capital budget. This is for the big things, the long-term investments and loans. Got it? Daily stuff and big stuff. All right, so let's open the diary and look at the first part. Where does the money come from? In government language, all the income is called receipts. It's just like at our homes, right? The family has different ways of earning money. Okay, so the first kind of income is called revenue receipts. This is the government's regular day-to-day income. And here's the most important thing you have to remember. This money does not create any debt. It's exactly like your papa's monthly salary. Once it comes into the house, it's ours. We don't have to give it back to anyone, right?
So where does this salary for the government come from? Well, two main places. First, of course, is tax revenue. This is the money all of us pay as tax. Income tax, GST, all of that. The second is non-tax revenue. This is stuff like profits from government companies, say Indian Railways, or the fees you might pay for a passport service.
Now, let's look at the second type of income, capital receipts. And listen carefully, this is very different. This is money the government gets by either taking a loan, which means they have to pay it back later, or by selling something they own, like some shares in a company. The best way to think about it? It's like your family taking a big home loan or maybe selling the old family scooter to get some cash. So this is the main difference, the one you absolutely have to remember for your exam. Revenue receipts, think of it as clean money, like tax, which doesn't create any future problem. But capital receipts, like taking a loan from the World Bank, well, that gets your money today, but it either creates a debt you have to pay back or you lose an asset. Simple as that. Okay, we've seen how the money comes in. So now let's flip the page in our diary. Where does all this money go? This is the government's expenditure, or as we say, it's kharcha. First up, we have revenue expenditure. This is all the money spent on just running the country day to day. Think about your family's monthly budget for things like groceries, the electricity bill, school fees. This spending is super important to keep things running smoothly. But, and this is key, it doesn't create any new asset for the family. And then we have capital expenditure. Now, this is the exciting stuff. This is the spending that creates assets for our future. In a family, this would be like buying a new house or a new car. For the country, it's about building those massive new highways, new hospitals, or shiny new metro lines that we will all use for years and years. And this is the whole story right here. Revenue expenditure, like paying salaries to government employees, keeps the engine running today. Capital expenditure, like building a new highway, is an investment for tomorrow. It's that simple, really. One is for consumption, the other is for creation. Okay, so a very important question. What happens when the total kharcha is more than the total income? You know what happens at home, right? We have to borrow money for that month. Well, for the government, this exact situation has a special name. It's called a deficit. And don't worry, the word sounds big, but the concept is super simple. The first type is called the revenue deficit. This happens when the government's daily running costs, the revenue expenditure, is more than its daily regular income, the revenue receipts. This is a bit of a warning sign, actually.
It means the government is borrowing money just to pay for its everyday bills. Next up is the big one, the one you always hear about on the news, the fiscal deficit. It sounds complicated, but it's not. All it means is the total gap between the government's total spending and its total income. This number basically tells you the total amount of money the government has to borrow from all over the place to fill that gap for the year. And finally, there's the primary deficit. Now, to get this, just imagine the government has loans from previous years, okay? The fiscal deficit includes the interest payment on those old loans. The primary deficit is clever. It takes the fiscal deficit and subtracts those old interest payments. Why? To show us exactly how much the government is borrowing just for this year's expenses, not for the baggage of the past. All right, theory part is done and dusted. You guys are doing so well. Now it's time to get into exam mode. Let's get ready for the exam hall. I'm going to tackle two of the most popular, most frequently asked questions from this chapter. So, full attention now. Okay, here's a classic one. I'm sure you've seen it in past papers. Why must public goods, things like streetlights or our national defense, be provided by the government? Why can't a private company just do it? Let's break it down. The easiest way to understand this is with a simple example. Think about a packet of Lay's chips. That's a private good. Why? Because if I eat it, you can't eat the same chip, right? So it's rivalrous. Also, if you don't pay for it, the shopkeeper will not give it to you. That's excludable. Now think about a streetlight. It's a public good. We can all stand under it and use its light at the same time, so it's non-rivalrous. And can you really stop someone from using that light, even if they didn't pay tax? No way. So it's non-excludable. So here's your perfect answer for the exam. Point number 1, because they are non-excludable, you get something called the free rider problem. People will use it without paying for it. No private company can make a profit like that. Point number 2, they are non-rivalrous, meaning one person using it doesn't stop others from using it, so it makes sense for society as a whole. And the conclusion? That's why private companies won't provide them and the government has to step in. Okay, another very important question is coming your way. What is the relationship between revenue deficit and fiscal deficit? How are they connected? What's the story here? The answer is actually quite simple. Just think of the fiscal deficit as the father of all deficits. It's the big one, the total borrowing. Now, the revenue deficit is just one part of it. Think of it like a child of the fiscal deficit. And here's the catch. If this child, the revenue deficit, is very big, it's a sign of trouble. It means a huge chunk of the total borrowing is just being used for daily expenses, not for creating future assets. And that's a wrap. See, I told you it was simple. You've done an amazing job just listening and understanding this. I am genuinely so proud of all of you. Now go and just ace those exams. But before you go, one last thought for you. If you were the finance minister of India, what's the one big capital expenditure project you'd want to spend money on next? A new highway? A world-class university? Maybe a space mission? Think about it. All the very best.